Hello everybody and welcome to our Module 9 discussion for financial statement analysis. This module is broken up into two different parts to cover the different aspects of financial statement analysis. Part 1 is where we are right now, and for Part 1 we are covering the first three items in this agenda: the purpose and tools for analysis, kind of a background. Then we'll talk about horizontal and trend analysis, and finally vertical analysis. Part 2 will cover the ratio analysis, all of the different types of ratios. So first of all, when we talk about financial statement analysis, what are we really referring to? What is the purpose? The idea is that when you've prepared the financial statements for a company, that's a good starting point for that analysis, but you're looking at raw numbers. You're looking at that year's numbers for this one company, and by itself, without any sort of context, it is to some extent meaningless. You need to be able to compare that against something to get relevance out of that number. Now, when I say compare against something, there are a variety of things you can compare against. You might be comparing against prior periods, that same number in prior periods. You might be looking at other companies, similar size competitors. You might be looking at industry standards or industry averages. And in some situations, you might just have general rules of thumb for what is expected for that type of ratio, although I will say these are the weakest comparisons, depending largely on the industry you're in. And you also may compare one amount on a financial statement to other amounts in the financial statements, which brings in the ratio analysis that we'll cover in Part 2. So what information are we analyzing to begin with? The core of the analysis is certainly the financial statements, both the current and at least one prior year, sometimes multiple prior years. And to do this, we create what are known as comparative financial statements. And this means that we would not just be reporting this one year. We might have the last 3 to 5 years that we're comparing against. And that's a large purpose of this analysis, certainly the horizontal analysis that we'll talk about. We would also be looking at the footnotes to the financial statements to help explain any differences in how those numbers were calculated across the years, and just to give even more context to the numbers. Now the next question is, where do we get the financial statements to review? When we're talking about a textbook perspective, of course the problem will generally give you the financial statement that you're looking at, or at least an excerpt of it. But in real life, you have to identify that financial statement. Now, there are a few different ways of finding this, actually several different ways of finding this. One way is simply to go to that corporate website that you're looking at. You know, Coca-Cola, PepsiCo, GMC, whatever company you're trying to review. Just do a quick Google search, find that company's website, and generally they will be posting their financial results there, if they're a publicly traded company, for sure. But if you want a more formal approach and a way to find multiple companies pretty easily, the SEC.gov website, Securities and Exchange Commission, this is where publicly traded companies in the United States, they're required to file their financial statements, and this is the portal to find them. So notice this screenshot here, sec.gov. You could simply search in Ford Motor Company, GMC, General Motors, PepsiCo, whatever you wanted to look for, and it will give you a pretty good result for that, and you'd have to search for the right year. You might come across situations where a lot of companies have similar names, so you have to find the right one. You could also click on company filings, and it'll take you directly to, the 10K, the 10Q, those particular statements. So here we have the 10K annual report, the 10Q quarterly report. That's generally what we're looking for when we talk about this financial statement analysis, and specifically where we tend to focus on the 10K. That's the required annual report. This one I wanted to point out very clearly because I talked about Ford earlier. So let's say I just typed in Ford, F-O-R-D, in the company search. I might be surprised to find a completely different company, Forward Industries Incorporated. So FORD is the NASDAQ ticker symbol for Forward Industries. So basically just be careful that you find the right one you're looking for. So let's say we did indeed want to look at Forward Industries and subsidiaries, the consolidated financial statements. Consolidated means that this particular corporation has multiple subsidiaries underneath of it, and they've consolidated them all together. They own more than 50% of whichever subsidiary is in question, so they're consolidating the results. Now what you'll notice here is pretty standard across all financial statements or most financial statements. The very first thing you're going to see if it's a publicly traded company is a report of the independent registered public accounting firm. They want you to read that first before you read the financial statements, because the auditors are giving an opinion on whether they believe that those statements were prepared fairly in accordance with generally accepted accounting principles, GAAP. So you want to read that, and hopefully it's what's known as an unqualified opinion. I know unqualified, that word sounds bad. You don't want your physician to be unqualified. You don't want your lawyer to be unqualified, but you do want your financial statements to be unqualified. The term in this context means that it's fair with no exceptions. There are no qualifications noted, nothing we need to explain further. It's fairly stated in accordance with GAAP, and that's it. If it was a qualified opinion, that means it's mostly fairly stated, but we found a few things we need to call out to your attention. We'd prefer not to see that. So again, that's the report. But then you get into the core of our discussion, the financial statements, the balance sheet, the statement of operations or the income statement, that's also known as the income statement, statement of shareholders' equity, and statement of cash flows. And you'll notice here they're reporting two different years, 2020 and 2019. So right off the bat, we have 2 years that we can compare. So now we're going to get into the different types of analysis. Now I mentioned for part 1, we're covering horizontal analysis, trend analysis, which is really a type of horizontal analysis, and then we'll cover vertical analysis. Part 2 is where we cover ratio analysis in more detail. We go through the various types of ratios we would be looking at. So here, we will first talk about horizontal analysis. And if you think horizontal, you'll notice you're looking across the report, left to right. And specifically, it is a cross time. It's a dollar and percentage change from 1 year to the next. So we show the increases or decreases from either 1 year to the next year, or in some cases across multiple years. Now, one thing I do want to point out here, this is just a quick screenshot of a horizontal analysis. You have to pay attention to which year comes first. Here, the current year is first, and then they just show the prior year behind it. You might see statements that reverse it. Really doesn't matter. You just need to make sure you understand which one is which. And then notice they have all the assets, liabilities, and stockholders' equity. So we would show the amount, again, from the old year to the new year. There's a $16,000 increase, and that calculates out as a 17.78% increase above that prior year. That's an important thing to understand when we get to the calculation in a bit. This percentage is always on top of the prior year or below the prior year if it's a reduction. It's not 17.78% away from 2020, the current year. It's always compared to the prior year. So we have positives here, but notice down here with retained earnings, we have a negative $15,000. So that $15,000 negative amount would be divided by 170,000 to get this 8.82%, and of course it's negative because it's a decrease. But that's the point. The change is divided by the prior year amount to see what kind of change it is. Sometimes it's a zero change, but the point is you calculate the dollar amount and then you use that dollar amount, divide it by that prior year to get a percentage increase or decrease. Here we have yet another example of this. Now notice in this year, I intentionally flipped it around. For this year, the current year was first, prior year was second. Here it's the exact opposite, and in fact, we have multiple years. 17 to 18, 18 to 19, 19 to 20. And I just have a few pieces that we're comparing. But the point is, we take the 1 year's balance, whichever year is the latest year we're comparing right then and there, and then we divide that by that prior year that we're comparing against. So if we were looking at 12/31/20, for example, we're comparing that to the immediately preceding year, 12/31/19. So for cash, we had 80,000 minus 140,000. So that's a $60,000 decrease divided by the original prior year, 140,000. So that's a negative 42.857% decrease. Again, some years it increases, some years it decreases. Don't let that fool you. It's always divided by whatever that prior year that we're comparing against is, whether it's higher or lower. So here, now that was horizontal analysis. By nature, true horizontal analysis is 1 year to the prior year. That's it, just 1 year at a time. Trend analysis is where we're comparing across multiple years, comparing everything to that original base year, the earliest year we have listed in our chart. So here, everything is going to be compared back to the 12/31/17 numbers. So it's the same basic calculation, though. We would be taking 1 year, like in this case. Well, first, if you take 2017 divided by itself, of course you're going to get 100%. It's the same number. But then you move over and take 2018's numbers divided by the prior year, or the base year, I should say, 2017. And if we take a look at we're looking at cash specifically. So 135 divided by 150, now we're down to 90%. Now this is not a 90% change per se, so it's a little bit different than this calculation. This is just a percentage of that base year, how it's going, increasing or decreasing. So in this case, 135,000 of that amount is 90%. In 19, we'll do the exact same thing, but we're still comparing back to that base year. 140,000 divided by 150,000 gives us 93.33%. We're going to see a chart in just a bit that helps to explain this visually. And then in 2020, 80,000 divided all the way back by this original 150,000. Now we're at 53.33%. We could do that same thing for each of these amounts. What it ends up showing you when you chart it, when you put it on a graph, plot it on a graph, here we have a line for each of those accounts, each of the 4 accounts we listed, and you can see cash. It took a small dip in the first year, slightly increased the second year, and then took a large dip that final year. Equipment stayed the same. We didn't change it at all. Accounts receivable took a slight dip and then started an increase. Inventory stayed the same and then took an increase, which, by the way, if you take a look at this, sometimes just looking at how things compare might help to explain what happened. In this case, I could say that we had a significant increase in inventory at the same time we had a significant decrease in cash. That would lead me to believe that part of our cash issue is that we spent it on inventory. Maybe we paid cash for inventory. That's just a supposition here based on what I can see. There might be other things involved. But the point is, when you do this trend analysis, you can plot it on a graph and see comparisons that might not otherwise be easy to call out quickly. So now vertical analysis. In this case, we're going up and down the graph, up and down the table of data, the financial statement, instead of across time. We're comparing a specific account balance, like perhaps cash, to some total base amount. It's not a year that we're talking about anymore. It's a base amount within that financial statement. We're trying to find out a percent to total. In other words, cash compared to total assets. What percent of total assets is cash? Is cash 10% of our total assets? 30% of our total assets? That's what we're doing with vertical analysis. We would do the same thing with accounts receivable. Maybe that's 10% of our total assets. Inventory is 15% of our total assets. That's the kind of thing we're looking for. We can do this with both the income statement and the balance sheet. The income statement's actually more straightforward because everything is a percentage of the total sales. Revenues obviously are a percentage of themselves, total sales, that'd be 100%. Cost of goods sold is a percentage of total sales. Gross profit is a percentage of total sales. All the various expenses are a percentage of total sales. And finally, net income is a percentage of total sales. And they all have to add up to 100%. Now, we'll see an example of that in just a bit. The balance sheet, however, you have to think about it for a second. You have to remember that we have two different parts of the balance sheet. Assets, and then on the other side, it's trying to equal out to total liabilities plus equity. Now remember, assets equal total liabilities plus equity, so it's the same total number. So for your individual assets, it makes perfect sense to compare those to total assets. Cash as a percentage of total assets. But when you get into your liability and equity components, at first it makes sense to say, well, hey, accounts payable as a percentage of my total liabilities and equity is 5% or whatever. And then retained earnings as a percentage of my total liabilities and equity is whatever percentage. But it's the same thing as saying accounts payable is what percentage of total assets. It sounds like a weird comparison at first, but remember that number is the exact same thing number as total liabilities and equity. So whichever way you want to do it, it's the same calculation, whichever way makes sense to you. But what I want to tell you is a lot of textbooks you'll see, a lot of software you'll see, they list total assets as the base, even for liabilities and equity items. So just don't get confused, it's the same number. So let's look at the income statement. Now, what I have here, first of all, is just the income statement. Now, we're showing two different years. And I don't want to confuse you here. Vertical analysis is within just one of those years. Each of those individual years you can perform vertical analysis on. But you're not doing anything across the 2 years like we were with horizontal analysis. So sales here is $325,000, and everything below it is a percentage of sales. Now I do want to caution, I want to correct something I said earlier. I said everything needs to add up to 100%. That would work perfectly fine if you had no subtotals, but since we have gross profit, we have income from operations as a subtotal, income before tax, and obviously net income is the final amount. If you tried to add up all these different percentages, you're certainly going to come up with more than 100% because there's some duplication there. Each of these subtotals duplicates a number. So just be careful about that. If you take the individual components without any subtotals, those would have to equal 100%. Again, I could do this for each of these individual years, which is exactly what we've done here. We've done a 2019 analysis by itself, and then we went ahead and calculated a 2020 analysis. For example, I would take net income divided by sales, and I'd get 20.22% for 2019. I could take cost of goods sold divided by sales and get 58%, or if I tried it in the next year, I'd get 62%. But it's a percent of the total in that year. Now what I want to point out though, we've done vertical analysis to get each of these individual years in a percent format. This is often referred to as a common size financial statement, common size income statement, because now what we can do is take a look at the percentages to total and compare those across the 2 years. So we can see that, hey, our cost of goods sold has increased as a percent of total. If you just look at these two numbers, you could say, well, yeah, it's absolutely increased quite a bit, but you know what? So did sales. So I would expect cost of goods sold to increase as well. But if you look at it a percentage format, you see that not only did it increase as a number, it increased as a percentage of total. So our prices for the inventory we're buying have increased, and therefore our gross profit has decreased. But what we can see then is selling, general, and administrative expenses as a percent of total sales have decreased across the years. We've been able to save money percentage-wise. Interest expense has dropped. Maybe we refinanced, maybe we paid off some debt, whatever. Income tax expense has increased as a percentage of total sales. And overall, net income has decreased just a little bit as a percentage of total sales. So this is vertical analysis. And that takes us to the end of part 1 of our financial statement analysis. We're going to come back with part 2 and talk about the ratio analysis.